I'm now joined by Gregory Daco. He's EY's chief economist. Gregory, good morning.
Good morning.
It's great to have you on the show today. And what should our viewers know about the October jobs report?
Well, I think the first and most important element is that this was a very muddied report. We had a couple of hurricanes that unfortunately hit the U.S. During the period of survey for the payroll survey, and we had a couple of strikes that reduced job growth. So this report is very hard to read when it comes to the underlying pace of job growth. We know that the headline print was only 12,000 jobs, but there was a major drag from both the strikes and the hurricanes. So when you look at the underlying trend, the underlying momentum in terms of job growth, I would focus more on the 3-month moving average of September. That shows that the U.S. economy is adding about 150,000 jobs on a monthly basis. That is weaker than where we were last year and shows reduced labor demand and reduced labor supply absorption, but nothing dramatic, no recession in sight, really just a softening of employment growth.
Would you still consider that 3-month average, Gregory, which you referenced there a moment ago, to be a healthy figure for the jobs market?
Well, certainly the October 3-month moving average of only 100,000 is distorted by the fact that we had this major disruptions in the month of October. So I would focus more on 150,000 over the course of the 3 months through September as a good gauge of where the labor market stands. And 150,000 jobs per month is healthy, but it is slower than what we've seen over the course of the past few years. And it indicates that business executives are being more cautious, more judicious with how they hire and who they hire. They're looking for specific skills, and they're not necessarily in great need of expansion when it comes to the labor force. So there is that underlying softening in the labor market that will likely lead to more softer consumer spending growth as we approach 25.
I do want to talk about wages. Average hourly earnings are a key element of the jobs report that we get every month, the first Friday of every month here on November 1st. But we do see that those rose 4% from the same time a year ago, and that is outpacing the inflation gains that we've seen. How does that factor into your own estimate for consumer spending going forward and the health of the economy?
Yeah, I think what we have to look at is really the monthly momentum in terms of wage growth. Yes, we did see wage growth pick up to 4%. The monthly momentum was 0.4 percentage points over the course of this month. I think what's important to keep in mind is that outside of some of these distortions, we're seeing moderating wage growth dynamics. And very importantly, when it comes to the Fed and where inflation pressures are coming from, an environment where you have wage growth at 4% is below the pace that would be consistent with 2% inflation when productivity is as strong as it is. Because let's not forget, productivity growth in the US is around 2.5%. So 2.5% productivity growth plus the 2% inflation target gives you wage growth around 4.5%. We're at 4%. So we're below that pace that would be consistent with 2% inflation, which tells you that there are very limited inflationary pressures coming from the labor market today.
Interesting. So sticking with the point of inflation, we did get that PCE index yesterday. That, of course, is the Fed's preferred gauge ahead of this Fed decision next week. Are you finding a bifurcation, Gregory, that we've seen in this economy for households at the higher end who have benefited from massive stock market gains in the past few years, and of course lower income consumers who are still struggling, it would seem, to really pay for those essentials in this environment?
Yeah, I think there's a misleading narrative out there that there is one consumer. The reality is that there are multiple types of consumers. Consumers that are at the lower end of the income spectrum are more debt constrained. They're more constrained by lower income growth. They have reduced savings buffers, and they're the ones that are exercising a bit more prudence. But consumers at the higher end of the income spectrum are still spending relatively freely. So you have this bifurcation in the consumer outlook. If you look at the broad trends in terms of the economy right now, we have a gently softening labor market, as we just discussed. We have more cautious consumer spending activity, and we have disinflationary fundamentals. All of the right ingredients to set the pace, the Fed, on this gradual easing pace of essentially easing monetary policy by 25 basis point increments to neutralize and recalibrate the stance of monetary policy.
So that's what I want to talk about. Of course, the Fed has maintained that it is an independent agency, i.e., it's not driven by politics or whomever is in the Oval Office. We know the Fed chair, of course, appointed, though, by former President Trump. I'm curious here, Gregory, with these key data points this week, GDP on Wednesday, inflation on Thursday, and the jobs report today, does that change your forecast for the Fed's path forward on cutting rates?
No, I mean, if you look at the broad set of data that we've received over the course of the past few weeks, you have essentially a picture of an economy that is gently decelerating. The labor market is not falling off a cliff, but it's not reaccelerating either. So you have gently moderating labor market momentum. Inflation, according to the Fed's preferred gauges, is within striking distance of the Fed's 2% target. So both elements of the mandate are essentially balanced, and risk tilting to the side of excessive weakness. So the Fed needs to recalibrate monetary policy away from where it was when inflation was at 6% towards an environment that is much more balanced and where you need to be closer to a neutral stance of monetary policy. That means a gradual easing of monetary policy to avoid being or having to be excessively reactionary if the economy slows further.
One thing I want to ask you, Gregory, as an economist, is we've seen the stock market now in its second year, past its second year of a bull market, up more than 60% roughly from that October 2022 low. How do those stock market gains funnel through to economic activity?
Well, they funnel in different ways. For households, they funnel via the wealth channel. So individuals that are invested in the stock market benefit from those stock market gains via the wealth channel. And one of the interesting dynamics post-pandemic is that we've seen a greater marginal propensity to spend out of wealth for wealthier individuals. And that's been one of the key reasons why individuals at the higher end of the income spectrum have been doing more than their fair share of overall spending when it comes to consumer spending activity. That's one way. The other way is that it continues to support business investment. And you continue to see business executives, especially the ones across the sectors that are doing the best, that are continuing to invest, continuing to drive growth forward, and continuing to look to expand, even though there is more subdued growth momentum in the broader U.S. economy.
Gregory Daco, EY Chief Economist, thank you for joining us early this morning after that October jobs report.